Is the stock market going to crash? A stock market crash could happen soon. And the weird thing is, people don't seem to care. For the first time ever, there's this weird feeling that people don't seem to care whether the market crashes or not. They've seen fantastic returns on the stock market and in crypto over the past year, and they think they're invincible. Well, today we're going to talk about why you should care, why it could crash, and make sure you stick around to the end because I'll tell you what this means for you. So currently, I've got 71% of my portfolio held as cash, and choosing where to invest it seems particularly difficult at the moment. Now, before I start, people will tell you, don't try to time the market, it doesn't really matter. Well, in general, that's true. If you invest monthly and you want to set and forget, that's no problem. Now let me tell you why it's an issue for me. Now, I've made this mistake in the past. In fact, last year, I managed to buy the day before the crash. Yay! How lucky am I? Luckily, last year I managed to buy the dip because I had cash available knowing that something would happen and there'd be great opportunities in the market. I managed to make over 50%, but it could have gone much worse. Now let me just illustrate why it's so scary for me in particular. So my cash position is currently standing at 175,000. Now let's look at somewhat of an extreme example and look at the 2020 crash. So if we look at the price of the S&P 500 on the 14th of February, 3380, to the price on the 20th of March, which was 2304, that's a 31% decrease in the market. So my 175,000 would be worth 120,750. But the problem then is, to recover from that 31% drop, I need my money to do 44.9% just to get back to where I started. Now, of course, if I had plenty of time to wait, that would be negligible. And it wouldn't really matter because I just wait for the money to recover. And I'm not sure how long I'm looking to invest for. I could be looking at a 12 to 18 month period. And if that's the case, it's not really long enough to recover from a drop. But even with that theory of it doesn't really matter and you can wait for it to recover, waiting months or potentially years just to recover from the drop isn't really ideal. That's a lot of profit that could be wasted. The recovery we saw in the market last year was particularly odd. It was extremely fast, and in the past it's taken much longer to recover. At the market's worst point in 1932, it lost 89% of its value, which then took 23 years, a whole generation, to recover just to get back where you started. And of course, nobody knows when it's going to crash or when it's going to recover, but the fact is it's going to happen at some point, and it's looking like it could happen soon. We don't know how much the market could reset, but let's take a look at some of the reasons why it could come crashing down. The US stock market is showing cracks. The tech-heavy Nasdaq has been trading lower for 3 consecutive weeks, which is raising concerns with traders on Wall Street. Traders are debating whether this is a sign that the recent rally is ending and a crash is on the horizon. Now let's look at 5 reasons why the stock market could crash. The first reason is the high valuation. The largest threat facing the stock market at the moment might be the historic valuation. As of May, the Shiller S&P 500 price to earnings ratio, or PE ratio, was 37.53. This is the price divided by the average of 10 years of earnings adjusted for inflation. 37.53 is double the average Shiller P/E ratio for the S&P 500 since 1870. And any time it's jumped above and sustained above 30, it's been bad news for the stock market. In the past 4 times when the P/E ratio jumped above 30 in a bull market, the S&P 500 dropped between 20 and 89% of its value. Reason number 2 is big tech is having less of an impact on the market. Google, Facebook, Microsoft, Apple and Amazon all reported extremely good earnings last month, better than expected. These earnings outperformed people's expectations, and even so, the index has been declining over the past 3 weeks. These big tech stocks have seen incredible numbers, reaching record highs over the past year. Analysts believe these stocks are due a correction as the economy recovers due to a decrease in COVID cases. A solid example of this is the price of Amazon, which dropped 6% after announcing extremely good earnings. Now this is alarming because when results come out and they're better than expected, usually the price should go up, which suggests the possibility of a stock market bubble. Reason number 3 is Joe Biden's capital gains tax. Joe Biden has made a suggestion of increasing capital gains tax in the US, which has worried investors. If this proposal gets a green light by the Senate, it could trigger a market meltdown, as traders are very nervous and looking for any reason to sell off their shares. Because let's face it, none of them want to keep their shares when the market is crashing, so they're ready to sell and buy back in at a much better value. Reason number 4 is political uncertainty. Now, Janet Yellen, the US Treasury Secretary, has confused traders last week on Wall Street. She stated last week that interest rates may be raised to help prevent inflation in the economy, causing the stock market to fall because she was implying that inflation is a growing concern. She later retracted her remarks, saying that inflation isn't a concern. She said she's not trying to influence what the Federal Reserve should do, but by this stage the damage had already been done, which has left confusion in Wall Street. Now let's take a look at reason number 5, which is the Buffett indicator. Now the Buffett indicator is a simple ratio created by Warren Buffett, who, as I'm sure you know, is one of the most successful investors of all time. Now the Buffett indicator measures the market cap of the US stock market with the annual GDP, gross domestic product, which is essentially the value of all goods and services produced in that year. He warns that if the ratio hits 200%, then we're in trouble. The market cap is currently 42 trillion and the GDP is 21 trillion. So that currently puts us at 199.9%, which is a bad sign for investors. So there's 5 solid reasons that could contribute to the stock market crashing. We don't know when it's going to happen, but it's likely to be some small factor that sets it all off. But the question you really want the answer to is, well, what do we do about it? Well, I'll be releasing my full plan on what I plan to do with my money and how I'm going to approach the next 12 months of investing. So if you haven't already, make sure you stick around and subscribe for that. And drop that like button to let me know it's something you want to see. Well, here's 4 things you can do to help reduce your risk if the stock market crashes. Now, the first suggestion is going to be understand your risk ahead of time. So you need to think about what financial position you're in. If you were to lose money, how much can you afford to lose, and can you afford to wait for it to recover? If you're not able to wait for it to recover, maybe sell some of your holdings and pull back. If you're a long-term investor, then this doesn't really matter. You can keep investing and let it pan out. The second thing you can do is reassess your holdings. At what point did you buy the company? What are they worth now? Are they still as good value as when you bought them? Is it a good time to take some profits and sell off and wait for a better opportunity? It might also be a really good time to diversify. Gold at the moment is looking like a really viable option and something I'm looking into, because I think a lot of signs are pointing to gold. I also do think, and I'll say this time and time again, at the moment I think the FTSE 100, the UK companies, is a much stronger investment than the S&P 500. We've had that fall with Brexit and coronavirus, and we're still on the path to recovery. So I still think there's a lot of room for recovery there. Where the US stock market is extremely high, and it could come crashing down. The only problem here is why I'm not going all into the UK. If the stock market falls in America, it's going to fall here, which I wish wasn't the case, but hey, it's something we've got to deal with. Luckily, so far, the companies I have bought, when things have fallen, they don't seem to fall quite as far. So the main 2 companies I'm holding are Aviva and Taylor Wimpey, but I'll share more on that later. The third thing I'm going to say is have cash ready, which sounds obvious, but some people just don't think about it. So if something drops and you see a really good valuable opportunity, you can put your money in, jump in and get that nice return. Just last week, one of my regular companies was down 7%. I put more money in and I made £6,000 within a couple of days. So it just shows you how powerful having cash available can be. And the fourth thing you can do is average into the market. So buy on a regular basis, so you're buying the highs, the lows, and you get an average return. That way, if it drops, you're going to still be putting money in and you're going to get good return on that dropped money. Now, there's some stats that show investing a lump sum in one go is better than investing monthly, but it's not really the case at the moment. Because it's also high, there's a massive risk potential if it does drop. So hopefully you guys found that helpful and it's given you some insight into the current state of the market and my whole mindset, where I'm at and why I'm worried about investing too heavily. So if you enjoyed this video, please smash that like button and I'll see you guys next time. Thanks.